Hello, good day, everyone out there. Thank you for attending. I promise you today will be a very impactful podcast and presentation. And without giving anything away, my name is Seewing Yee from the Yee Real Estate Network. And my special guest is once again, Miss Maureen McCann. Hello, Maureen from—
Hi, Seewing and guests.
Yep, from Sparta Invest. Thank you for attending, Maureen. We share some very, very good topics. And at the end of the day, we want to benefit the real estate investors out there. And hopefully today's presentation will be no different. So without further ado, let's get started.
Let's do it.
Yep, let's do it. So today is a very, very important topic, and it's not something new. It's just that we're gonna, just talk about it in different ways, so you could really see, what you've been missing. Whether you are experienced real estate investor or a newbie, you need to really, digest this, and at the end of the day, you're gonna feel how lucky you are. You're potentially embracing this strategy, this process. And so the theme is your 30-year fixed rate mortgage is the ultimate icing on the cake, is the premier real estate wealth building vehicle in history. Your 30-year fixed rate mortgage. People hear about OPM, other people's money, people using about having good debt, right, versus bad debt is good. People hear about leverage, the word of leverage in using investment real estate is also a very, very powerful terminology as well. So we can describe it in a very unique way. So 30-year fixed rate mortgage, so let's think about that. Now, if in the US, as far as I know, USA, United States, is the only country that have a 30-year fixed rate mortgage, as far as I know. And I've been to a lot of countries in my lifetime, maybe like 40 countries, all right? And I do not believe if a person lives somewhere else in a country in Europe or Australia or UK or wherever in Asia, whatever, I do not believe they have this kind of unique strategies, and so those foreigners live in their own country, they have to, when they buy real estate, most likely they have to pay by cash. If not by cash, their loans they're going to get are very nothing compared to what we get in the US. So at the end of the day, fixed rate mortgage, and I'm going to have your thought process, Maureen, momentarily, is the I could even go as far as saying is the eighth wonder of the world. Eighth wonder of the world. I mean, Albert Einstein, coined the term eighth wonder of the world, which is the magic of compound interest, and what have you. And we can discuss that some other time. Yeah, it's the greatest invention. The 30-year fixed rate mortgage is the greatest invention in the real estate world ever, and so the reason why are very, and Maureen, you can say that as well, as long as you pick the right market, right? As long as you put this as an investor, you put this vehicle in a right market, you buy at least 20 to 25% down payment, you can at least break even or have a positive cash flow. And then using this 30-year fixed rate mortgage it'll change the trajectory of your financial future, just like that. All right. And obviously, fixed rate mortgage is powerful because it's a hedge against inflation, right? It doesn't go up and down. I mean, this is mind-boggling. Think about it. Whether you're paying currently 6% interest rate or 5% mortgage rate you're paying, or 3.5%. A lot of people pay like a year and a half ago. I mean, which is a historical rate. I mean, a lot of people or got spoiled based on the historical low rate. That's why the real estate market has, have broke all kind of records or whatever. So yeah, isn't it amazing? I mean, your payment never change over time. I mean, inflation or rampant cost of living. You talk about, you look at, used car prices. You look at cost of food right now and cost of gas, cost of everything has skyrocketed. We know renters, they're paying the landlord increasing the renters rate over the country 10, 20, 30, 40, 50%. Might as well say 100%. Your rent has increased. So everything, the time value of money, imagine, 30 years ago, the cost of a stamp is like 3 cents. Today's cost of a stamp is, I don't know how much, I forgot. I don't use stamps anymore. Anyway, so you get the idea, right? So this is amazing, right? This is historical. I mean, having the ability to have your 30-year mortgage, and you can buy mostly single-family homes. This is the core investment, the best investment strategy. I'm sure, Maureen, you agree with me. Single-family home residential investing is the best market. I mean, it's the best type of investments. Maybe even duplex, triplex, and fourplex. Yeah, it's okay too. But beyond fourplex, that's something is not on my plate. So 1 to 4 unit, if you can use the Fannie Mae lending guideline, right? The amazing Fannie Mae lending guidelines for primary home buyers and for investors, and apply this 30-year fixed rate mortgage. And if you can get a lot of these mortgages, multiple 10, 20 of these mortgages, your life will change, forever, for your future, for yourself and your family and your loved ones into your next generation, whatever. So with that in mind, so Maureen, it's your turn. So go into detail. Let's take a deep dive. Why a 30-year fixed rate mortgage, even at this rate? I know for investors like 6%, for primary home buyers 5%. We don't know the future. It may go up, it may go down for the rest of this year. We don't know. But remember, before Maureen, you say anything, do you know this 6% interest rate? People think, oh, the sky is falling, right? You have to be careful out there, right? The news media and the mainstream people are just, doom and gloom. The earth is crashing, the real estate crashing, or whatever. It's just so much negativity out there. And I mean, I know in the past 10 years, the interest rate were maybe 5%. Then before that, in the early 2000s, the interest rate was 6%. And you talk about the 1990s, the mortgage interest rate were about 8 to 9%. If you go all the way back in 1980s, Maureen was very, very small at that time. You don't remember anything. You're not an adult at that time. I was an adult at that time. Back in 1980s, the mortgage interest rate were as high as 18%. And people at that time were still getting financing to buy homes, right? So you guys are spoiled right now, all right? So I'm just giving you a very quick historical perspective. 5 to 6% right now is not the end of the world. It's still at a historically low rate, right? You don't believe me? Do your own research out there, right? You can Google the interest rate, and you will. I can validate what I just said. So this is no hype. I'm giving you factual information because I've been a real estate investor for several decades. I have consulted thousands of real estate investors, and I understand loans. I'm not a loan expert. I'm not an expert in the economy. Maureen, same thing. You have consulted with investors for the past more than a decade, thousands of investors, and you understand how financing and mortgage rate impact people. So from your perspective, now is your turn, Maureen. Why, dive deep, why a 30-year fixed rate is the mother of all real estate, a wealth building vehicle? And so tell me.
Yeah, it's definitely a unique tool that, if utilized the right way, can produce the wealth that you want for your families and us too. So I always like to go back a little bit deeper, right? So where did the 30-year fixed mortgage come from? Where was the idea? The idea was born in the United States. I don't really know who created it, but we got to give credit to that individual, probably a guy. right? He's thinking, okay, he's a banker, he or she, let's say he or she's a banker, and they go, you know what business model can we create that would be very profitable for us for a really long time? And if you think about their brilliance is amazing in that they go, you know what, let's create a 30-year fixed mortgage product that we can make available to all citizens in the United States. And what we'll get is we'll give them 80% of whatever they want to borrow. We're going to give them 80%. They got to come in with their 20%. We're going to give them 80% of our money at a fixed rate for a 30-year period. And guess what? We're going to collect the majority of our interest all up front. That's a really good business model. And hey, guess what, you guys? You can refinance at any time and restart the clock, right? Because interest rates will go up and they'll go down. And when they go down, you'll refinance. My clock will restart another 30 years. And I again get all of my interest up front. It is a brilliant, beautiful business model or a tool that not only is offered by a bank, but it's beneficial to us as investors. And here's why. It's very simple. You get into a certain fixed mortgage payment, right? It's fixed. It's never going to change. It stays just like this, right? Interest rates can go up and down. The cost of goods can go up and down. Gas, inflation, we're at a high point right now, maybe going higher, right? As gas, food, electric bills, water bills, anything continues to go up, guess what stays the same? Is your mortgage payment fixed for 30 years, right? So guess what happens over that 30-year period too? Rents continuously rise, right? So maybe they start here and then year 2, they're here, and then year 3, they're here, then they're 4, 5, 6, 7. But guess what doesn't change? It's your mortgage payment. Wow. So when you talk about owning rental properties as a good hedge against inflation, this is one of the particular reasons why, because you are at a fixed rate, right? Now, a lot of us, Seewing mentioned this, a lot of us are very, very spoiled. We have been spoiled. We didn't live through I was actually, I was 10 years old in 1980. So not necessarily an adult, but I was alive, kicking. Okay. And I've seen the charts where you look back and you see the interest rates were 18%, mind-boggling. Like anyone that has bought a primary residence or any rental property, call it in the last 15 years, we have been extremely spoiled because these rates have been adequately below 5% for a very, very long time. And even not too long ago, people were refinancing their primaries for 2%, right? So investor loans are always a tick higher because there's more risk. A bank says, hey, look, if something goes sideways, then this particular investor is probably going to let their investment property go before they would let their primary residence go. So there's more risk. So there's more cost. It's just the way it works. And that's how we understand it. So when you look at how spoiled we have been, and now a lot of us are wah, because interest rates are at 6%. They're still historically low, right? They're just not the 3% or the 4% that we have been used to for the last decade plus, right?
Right.
And here, this is just, I know you've been doing this for 20 years. I've been at this for 13 years. Interest rate does matter. It does from a cash flow perspective. It really does. And if you're looking at just year one, I'm actually thinking of a client just now. I got an email from him this morning and he got his new rate and term sheet. And the interest rate was higher than what was expected from the pro forma that we were presented to him. We've since adjusted it because rates have fluctuated. They've risen very quickly in a very short period of time, days. So we had needed time to catch up, our pro forma to catch up to the current rate. But anyway, he got his rate and he ran his numbers and he's like, this does not make sense to me anymore. And I'm like, because you're only looking at it short term. You're looking at it for the next 12 months. it's not going to make sense for the next 12 months from a cash flow perspective, because if you were projecting cash flow off of an interest rate set at 5% and now at 6%, yes, it's going to lower your cash flow. It is. But the point is that the property still does cash flow. And in some markets, it's not happening because property taxes are too high. The insurance costs are too high because maybe it's a coastal and they've got flooding and the wind damage, and not wind damage, flooding and hurricanes. So they have to, the rates of the insurance increase. And so it starts pinching really much that cash flow. So what we're doing actually as a company is we've only taken the first 12-month picture, right? We're now looking out 3, 5, 10 years, because this is not a short-term rental. This is a long-term buy and hold. Right. And there are multiple ways that real estate pays you, 5 in particular ways that real estate pays you. Cash flow is just one, right? So as interest rates go up and your cash flow is not as much as you would like it to be, because we've been spoiled, especially if you bought before. If you were an investor and you bought 3 years ago, 2 years ago, 5 years ago, even 10 years ago, in your mind, you go, well, hey, where's my $100,000 house that cash flows $400 a month? That used to have, that was before. That is not now, right? Now we've got a different economic time. The economic time is inflation is rising. What is Seewing, I know you can answer this question. What is the best hedge against inflation? Owning what?
Owning real estate, investment real estate.
And who even just said that recently? You sent me a video and it was the chief economist of Fannie Mae, Duncan, I think is his last name.
Right.
And do you remember what he said on that? He talked about the housing market and how we're probably going into a recession in 2023. And it's probably going to be it's not going to be what was the word? It's not going to be an extreme recession. It's going to be moderated because of what? Do you remember what he said?
No, I forgot.
Because of the strength of the U.S. housing market, right, is the reason it's going to be a moderated, mitigated, I guess is a better word, recession. It's not going to be as extreme as it would be if, let's say, we were back in 2008 and the housing market was really on shaky ground. The U.S. housing market is on solid, stable ground. And as we continue moving forward throughout 2022 and into 2023, nobody knows what's going to happen, right? We can all suspect and have predictions and forecasts, which a lot of experts do. So I kind of like tuning into them to see what they say. We do think that interest rates will continue to rise, right? Now, what is that going to do for housing? Well, if you just look at, if I invest in real estate strictly for cash flow, and my cash flow, if I'm not getting $300 or $400 a month, it doesn't work for me, then I think that's a very short-sighted view. And here's why. Because there's 5 ways that real estate pays you. Cash flow is just one. Capital appreciation, depreciation, the loan pay down benefit, and the hedge against inflation are all ways that real estate pays you. And I just did an exercise with a new investor yesterday. I took them through the calculation of, rate of return is a very simple formula. It's just profit divided by equity. So we went through what the rate of return would look like if you bought a $150,000 property today, and that property appreciated 9% over the next 12 months, which is a very middle of the road forecast. I've got some experts out there and housing analysts are saying that it's going to be higher than that. I've got pessimists that are saying lower than that. We just took the Pulsenomics basic 9%, right, across the board. So $150,000 house, I think it was $13,500. I'm gonna cheat. Hold on one second. So I'm going by memory, but sometimes as I get older, my memory is not so good. So let's just make sure I'm on point. Okay, right? So you guys can follow along, right? So you take $150,000 house, multiply that by 9%, $13,530, right? That's what 9% would earn you on a $150,000 house. So let's say your cash flow for that particular property, I'm going to go low. I'm going to say it's 125 bucks, right? That's really low. I have properties in my market that cash flow more than that, but I'm just illustrating my point. So $125 times 12 months, that's $1,500, right? So this may not be very exciting to you, but if that property appreciates this much, 13,530 in 12 months, and you put down, let's see, it was a $150,000 house times 20%, that's 30,000, right? So rate of return equals profit divided by equity. So the profit on the equity, if it's 9%, some markets are probably going to do better than that. Some markets might do less than that. But across the United States, if the average is 9%, and by the way, you guys, last year, the average was 19.1%. Why? Low supply, high demand. Is that low supply, high demand going to change in 2022? Nope. 2023? Nope. Will it soften? It will, because people are going to be marginalized and have to rent more longer because they won't be able to afford a house yet until the rates come back down and make it more affordable.
Right.
But you have to look at the rate of return calculation and making the assumption if that $150,000 house appreciates 9% in the next 12 months, that's a $13,530 capital appreciation in that property. So we're going to take that value and we are going to divide it, because it's rate of return equals profit, 13,530 divided by your equity, which is your down payment of $30,000. And that gives you a rate of return of 45.1%.
Yep.
Okay. Right. That's just one. I haven't even talked about cash flow, the depreciation, the low pay down, or the hedge against inflation. Your rate of return just on the capital appreciation alone for 12 months was 45%. Seewing, do you remember what has the US government reported the current inflationary rate is right now? What is
at least 8%, probably higher if you talk reality.
Correct. So let's double it, right? Because we know that there's some fudgeability in those numbers, US government, sorry, but they did remove gas and food from that equation in the early 70s. So let's just toss those little factors back in and take their 8% and double it to say 16%. What does that mean for you guys as investors? It means this. Any vehicle that you choose to place your capital in, it must, absolutely must, make more than 16%. It has to make more than inflation, right? If you've got, let's say you've got, whether it's, call it 300,000 in cash sitting in an account or 300,000 in equity sitting in your home. If the equity in your home and your $300,000 cash in an account is not making more than inflation, then the value of these is eroding slowly. You're going broke slowly, because you have to take this money and get it earning more than inflation. So if this is inflation, this is your 300,000 earning you, I don't know, 1%. What's the CD right now? 1%, 2%? I don't know what it is.
Less than 1%.
Less than 1%, right? Okay. So here's inflation. Here's your 300,000 earning 1%, right? This money is not growing faster than inflation. You have got to get it moving faster than inflation. So I just showed you one rental property at $150,000. You put $30,000 down on it. That's 20%. And it appreciates 9% in the next 12 months, 13,530 bucks. That is a rate of return of over 45%. That is beating inflation. Here's inflation. Here's your 45% rate of return. That's just on home equity.
You know, there's a very deep dive, and you talk about just the first year. So let me do my hand signal. May I?
Yes, do your hand signals.
Here's my graph, aka my hand signal. Okay, now it's my turn to express in a way. I'm doing it. Okay, this is your 30-year fixed rate mortgage. You bought your property with $150,000, even $300,000 single family home, right? And you put 20 to 25% down payment. At the worst case scenario, you have a break even cash flow, or even minus $100 monthly negative cash flow. But think about it. Do you really need the cash flow to live? I mean, most of you are making 100 grand W-2 salary per year, or 200, or even $300,000 salary. A lot of my investors, most of my investors are located in the San Francisco Bay Area. I mean, they make six-figure income. Husband and wife make 300 grand. We're talking $25,000 monthly W-2 income. Is negative $100 per property gonna stress you out? Gonna bankrupt you? That's ridiculous, right? So, I mean, we all love higher cash flow, but just follow me for instance. Okay, 30-year mortgage. If the inflation is 8%, the rent will probably going to be at least 8, 10, 15%. So if the inflation goes down to 4%, the rental increase can be 4%. But knowing that over time, your renter, that's, by the way, our tenant, our renter is going to make us rich. That's without saying. And there are plenty of renters out there, tenants out there, more than ever. The rental nation is epic, it's historic. There's more renters now than ever before in history of the United States, because most people can't afford to buy a home these days, and in the future for the next 20 years they'll be renting. Hate to say this, that's the reality. So getting back to this, your rent going to increase at the rate inflation or higher. Your renter going to pay down your mortgage, your principal balance little by little. Okay. The first 2/3 the life of the loan is interest, we get it, but only the last the principal is very low. But if you look at the amortization, the principal pay down steadily, and the rental increase, and then your property taxes may not increase as high as your rental price increase, or your insurance, or your fixed cost of managing your property, what have you. So if you look at 5 to 10 years timeline, the graph, your cash flow can get higher because you're going to hopefully consistently raise your rent above inflation. Your renter can pay down the mortgage, and then let's say your equity growth, the appreciation, let's say a modest 5 to 7%. Compound interest. You must understand. Getting back to Albert Einstein, he said more than 100 years ago, I forgot when, how long ago, Albert Einstein, he said, compound interest is the 8th wonder of the world. Well, when you buy a real estate property, you need to understand 9% the first year appreciation, then the value of the house at the 9%, then the following year, if your property gain another 5%, I mean, the value of your house compound exponentially second, third, fourth, fifth, and sixth, seventh, eighth, 10th year. At the end of the 10th year, I mean, your loan, your amortization and the principal balance of the loan might pay down drastically. So the longer you keep the property, given the projection, we don't know the future, right? I mean, property may drop a little bit in value, because real estate is kind of a little bit cyclical, right, over time. But still, right, you look at the graph, cash flow will increase over time, next 10, 15, 20 years. Equity will grow. Your principal of your loan will come down to a point where at the end of 30 years, or even sooner, if you do an extra principal pay down, your loan could be paid off in 10 to 15 years. You can do one extra principal per month. A lot of you don't know that, right? And you can cash out refinance on the loan to value. If you have a loan to value at 70% or lower, you can cash out refinance to leverage more, to buy more properties at 30-year fixed rate mortgage, and then at the end of the 10 year or 15 year, you can do whatever you want. You can You can pay off your child's if you go to Stanford, 4 years tuition, room and board. You buy one or two of these houses in 10 years, you could finance, you paid off all your, a Harvard 4-year tuition, room and board. And then beyond that, if you get more of these 30-year fixed rate mortgages in 10, 15 years, I mean, you can retire. You can replace your W-2 income. You can retire early. You can do whatever you want with this financial windfall if you get multiple of this 30-year fixed rate mortgage. Again, the end of the day is don't worry about today's economy. Today's economy, the inflation, the war in Ukraine, or the drastic rise of the interest rate, and talk about don't worry about the crash, the corruption, all this negative news, doom and gloom news you hear out there. Just shut off the noise, all right? Focus on your personal economy. Given your financial resources, if you have the ability to get as many of this amazing 30-year fixed rate mortgage as you can, I mean, some of you can do it, within the first year. I have investors, you have investors that have purchased 10 of these rental properties through your network, through my network, in a matter of a few months. Yeah, because they have the money. Some people take it, they don't have enough money. It's investor, they can do it slow. You can buy 1 or 2 property per year. That's fine. So that's the goal. Long-term, steady, and just be positive and focus. And we spent almost 40 minutes on this. Oh my goodness.
I know, but here's what I think is really a good takeaway is that if you guys are listening to this, Seewing's not selling anything. I'm not selling anything. We're actually just giving you tips and tools and really highlighting the benefit of what the 30-year fixed mortgage, if you utilize it as a tool to create the wealth that you want for your family, it is possible. It doesn't matter what the interest rate is. People were buying real estate at 18%. I bought 2 of my first rental properties at 9.9% interest rate. They still cash flowed. So do I care? No, I don't care, right? I care that it cash flows. I care that the property appreciates in value, and I care that I get to reduce my taxes. And that is what for me, the takeaway, the summary point is this: creating wealth is done by doing 3 things: buying appreciating assets that cash flow and reduce your taxes. That's it.
Well, I have a final comment, Maureen, in that this podcast, I know is a little bit longer than necessary, but so what? This will be the main Bible, real estate Bible of training. This is do you agree, Maureen? I believe, in my humble opinion, that these past 40 minutes is a must watch. You must watch this, because no one out there in the real estate world are putting this presentation in the way that we just did, in the narrative, the another way to look at it, right? Don't you agree? It's
passion. It's wanting to help people just figure out how to navigate their way through this wealth building maze, because guess what? Most of us and I'm guilty of it, right? Most of us are like, hey, I was just told to put some money in the stock market. And I'm going to earn my 8%, and my company's going to match it, and then I'm going to be set for life, right? That's what, as I talk to these people, this is the level of their financial education, and they're waking up at 40 and 50 and 60 years old, and they're saying, I don't want to work until I'm 80. I'm going to outlive my money. What do I do now at this point in my life so that I don't have to work until the day I die? I need streams of income. How do I do it? I'm debt averse. I'm afraid of debt because I've listened to the Dave Ramsey mindset. And there is good debt and there's bad debt. If you take on debt that produces income, that the properties appreciate in value, and you reduce your tax liability, that is good leverage debt that you should use all day long, whether it's at 3%, 6%, 10%, or even goes up back to 18% at some point in the future. As long as you can use a little bit of your money, borrow a lot of someone else's money, and you can capitalize on collecting 100% of that capital appreciation or home equity in that property, 10 years down the road, let's say you've got 10 properties, right? Now they're valued, let's make it really simple. You've got 10 properties. They're all leveraged. And they're all valued at $100,000, right? That is $1 million worth of real estate. Welcome to the $1 million real estate club. There you go. No one has confetti at your door and says, welcome. It just happens gradually over time. Okay. So now I need my calculator again, because I can't do this in my head, right? But let's just say, you guys, you had that. You have 10 properties that you've accumulated over time. They were valued at $100,000 when you bought them. That's $1 million worth of real estate. And let's say you own those all right now. And Pulsenomics is forecasting a 9% increase in total values for that portfolio. That is, so you take $1 million worth of real estate times 9% overall, that's $90,000. That just shows up out of nowhere. It's called phantom income. Robert Kiyosaki calls it phantom income. It shows up simply because you're just holding the asset. You hold the paper that owns the asset, and it just appreciates over time. So let this just sink in, you guys. Debt is not good. Debt is not bad. Leverage debt to buy cash flowing producing assets is really good.
Well, Maureen, you says it all. I'll have one more recap, I promise. Look, you guys need to watch this video from beginning to the end, okay? All right? And this so-called training video, any potential new investors going to come into my organization, they must watch this presentation above everything else. Yeah, there'll be more training, yes, but this is the must. This is the blueprint. This is the ultimate. This presentation, I mean, it's just, if it doesn't resonate with you guys out there, then I don't know how else to help you, right? I mean, we put in a way that are understandable, that have a big picture, a lot of good concepts, a lot of great deep dive explanation that we both did, right? If you have to listen to this video more than once, feel free to do so multiple times, right? That if you click, that light bulb just click after you hear this presentation, and the rest of the information we can provide you. So as an investor, you can make an informed decision to invest in real estate. You and I have done our job. We provide, right, very in-depth, thought-provoking, mind-boggling, great information. You're not going to get anywhere else. That's how I feel, right? And you might prove me wrong, but look, Maureen and I, we're so passionate in what we do. We believe in it. We have consulted with many others. We have a vast amount of experience. We have created the blueprint for you to achieve your definition of American dream. Okay, I have achieved that dream already, and Maureen also as well. We just want to, just impart upon you. We just this is our core value. We want this is what we're out here for, to help people. Every one of you, all of you guys can do it. I mean, just you can achieve your definition of American dream, and we believe real estate investing is the way to do it. And hopefully, this presentation will provide value for yourself and your loved ones. And at the end of the day, really appreciate you listen to us, and at the end of the day, take action. Just do it, right? Nike, just do it, right? So Maureen, it's a pleasure, to have you talk about this. You're amazing. So thank you so much. I know this video have gone way beyond, but it's okay, all right? And we're done for the day, Maureen. You and I, thank you so much for your time. We go back to our regular job, of consulting many people out there. Thank you so much, Maureen McCann of Spartan Invest, and my name is Seewing Yee from the Yee Real Estate Network. Thank you so much. Have a nice day, and we will see you on the other side. Bye-bye.